episode of the Financial Intelligence Deep Dive, your daily source for sharp and focused market insights. It's Wednesday, and you know what they say. Midweek trading is like a hump day workout, painful to start, but you thank yourself later. Today is Wednesday, August 20th, 2025, and we're bringing you the intelligence brief for yesterday, Tuesday, August 19th. And yesterday was, well, a really fascinating study in market divergence. Global equities took a bit of a breather after their recent record highs. U.S. markets notably slumped.
Yeah, that was quite the contrast.
Right. The S&P 500 dropped for a third straight session, and the Nasdaq composite, wow, tumbled significantly.
Driven by that broad, risk-off mood, especially hitting those growth stocks hard.
Exactly. Yet across the Atlantic, European markets largely defied the trend, didn't they?
Yeah.
And some Asian markets showed pretty remarkable resilience, too.
A very mixed bag globally.
This update is powered by NextSight, a global intelligence company that does more than just gather data. With their open-source OSINT platform, Site Connect, they turn raw information into strategy, letting clients shape intelligence reports around their exact priorities. From financial market analysis to cross-border investigations, their work consistently operates on another level. You can learn more at www.site.com. And just so you know, today we've promised not to argue whether gold or coffee is the better safe haven asset.
We'll see how long that lasts.
Right. But I wouldn't bet on it.
Yeah.
Okay, let's unpack this complex market picture from yesterday. Let's start with what really stood out in U.S. equities. So while the broader S&P 500 and the tech-heavy Nasdaq saw declines, the Dow Jones Industrial Average actually managed to, well, eke out a small gain. What's the deeper story behind this split?
It's really interesting. What we saw was this clear rotation happening. Investors were pulling capital out of those high-growth names, which is exactly why technology stocks suffered the most. That broad risk-off tone meant people were reducing exposure to what they see as higher-risk assets, opting for maybe safer havens.
Right.
And this hit companies like Palantir particularly hard. They saw a double-digit drop.
Ouch.
Yeah, because they missed revenue expectations and also issued a forecast for slower contract renewals. That spooked investors. NVIDIA also slid. There were some analyst warnings that maybe the peak in AI chip demand might be nearing.
Really? That seems fast.
Well, maybe peak growth rates. But these aren't just single-day misses, right? They underscore this critical investor reevaluation. The market seems to be demanding clearer profitability, sustainable demand, even in hot sectors like AI. It's a sign of a more discerning market, perhaps.
So the market's becoming less forgiving, less willing to just bet on future growth without seeing the numbers now. But Home Depot seemed to be a notable exception here. How did they manage to buck that tech-led downturn?
Exactly. Home Depot provided a significant counter-narrative yesterday. Their fiscal Q2 results genuinely beat expectations. Revenue came in around, $39 billion? And they had a positive EPS surprise, too.
That's solid.
Very solid. And crucially, they also maintained their full-year outlook. So this strong performance, coming from a more traditional sector, it really helped cushion the Dow. It sort of anchored those defensive names.
Okay, that makes sense.
And if you connect this to the bigger picture, it shows that in a risk-off environment, businesses demonstrating, consistent, tangible profitability and reliable guidance can become really crucial anchors.
Right.
It's also worth noting, though, overall market breadth deteriorated. Decliners significantly outpaced advancers on both the NYSE and Nasdaq.
So Home Depot was more of an island of strength, not a sign the whole market was okay underneath.
Precisely. It was an isolated point, not a broad trend for sure.
Okay, so a clear theme in the U.S. tech struggled under that scrutinizing gaze, but solid corporate earnings elsewhere offered some, well, surprising resilience. But as you mentioned earlier, it wasn't a universal slump. Europe seemed to be marching to a completely different beat, and Asia was, as you said, a bit of a patchwork, wasn't it?
Indeed. Europe was quite strong. The STOXX 600 didn't just climb, it surged 0.69%. That was its largest daily gain since August 7th.
Wow. What led that?
It was particularly led by strength in retailers and utilities. Kind of suggests a defensive play, right? Investors seeking stability in essential services, consumer staples, maybe amidst those global tech jitters.
Makes sense.
And this was reinforced by strong industrial earnings that helped Germany's DAX. It added 0.45%, snapping a two-session slide. And the FTSE 100 in London, it even rose 0.34% to hit a new record high.
A record high. Amidst all this,
a new record, 9,189.22, supported by those defensive sectors again, and also a softer pound helped UK exporters. So this collective strength in Europe really did defy the global equity slump.
That is quite a show of localized strength. So how did Asia fare then, given these divergent global currents?
Asia was definitely more mixed. Japan's Nikkei 225 dropped 0.38%, partly as the yen strengthened. South Korea's Kospi fell 0.81%. Hong Kong's Hang Seng eased about 0.21%, still struggling with weakness in its property sector. China's Shanghai Composite was nearly flat, pretty muted.
But India stood out.
India really did. The Sensex rallied 0.46%. It was driven by heavyweights like Reliance Industries and Tata Motors. Investors there seem keenly anticipating potential goods and services tax, GST reforms. That provided a strong local tailwind, showing some real domestic optimism.
What's truly fascinating here is how Europe and India managed that, defying the broader global equity slump. It really speaks to localized drivers overcoming that global sentiment, doesn't it?
Absolutely. Specific regional factors were key yesterday.
Now, given these mixed signals in equities, you might expect more volatility across the board. Yet the bond market seemed relatively calm, almost holding its breath. What was happening with rates and credit spreads?
Yeah, rates markets were indeed calmer, almost in a holding pattern, like you said, probably waiting for potential policy signals. The U.S. 10-year Treasury yield held near 4.34%. This was as of August 18th. Traders are keenly awaiting Fed guidance, especially from the upcoming Jackson Hole Symposium.
That's always a big one.
Always. Similarly, the German 10-year Bund yield eased just slightly to 2.75%. That's just a 1 basis point drop, tiny shift. And the UK 10-year gilt yield stayed around 4.75%, so reflecting expectations of steady policy there too. Japan's 10-year JGB yield, though, that rose to 1.60%. There's ongoing speculation about the Bank of Japan's plans to exit its ultra-loose monetary policy, so a bit more dynamism there.
Okay. And what about credit markets? Were they mirroring this calm, or were there any jitters showing up?
Credit spreads actually tightened modestly. Remember, spreads are the extra interest companies pay over government bonds.
Right, so tighter means more confidence.
Generally, yes. It signals investors feel a bit more confident about corporate solvency. The ICE BOFE investment grade option adjusted spread was at 75 basis points, high yield at 288 basis points, both as of the 18th. These numbers indicate a relatively stable, though quiet, credit market. Flows were pretty muted. Equity volatility, the VIX, the fear gauge, remained quite subdued near 15.
Still pretty low.
Very low. Suggests maybe a degree of complacency among stock investors, perhaps. In contrast, bond volatility, tracked by the MBUE index, that registered roughly 82, so that signals a bit more underlying uncertainty, maybe more activity in fixed income compared to stocks.
Interesting difference there. So stable rates, tighter credit, but maybe a quiet period before Jackson Hole potentially stirs things up. This brings us naturally to currencies. The euro firmed, the yen firmed, the dollar slipped. What does this all mean for the currency markets, especially the yuan? That's always so closely watched for global trade signals.
Yeah, this dollar weakness was definitely a significant theme yesterday. The euro firmed against the dollar. The ECB reference rate was set at 1 EUR equaling 1.1682 USD and 172.667 JPY. The pound traded around $1.35. The yen also firmed slightly, implied USD JPY around 147.9.
So the dollar was down broadly.
Exactly. This broad weakness was reflected in the IC US dollar index, the DXY. It slipped to 98.278, down about 0.11% for the day. It suggests maybe a slight shift away from the dollar as the go-to global safe haven, or perhaps a collective market belief that other economies are catching up, or maybe the Fed might be less hawkish than some anticipate.
And that strategic move by the Chinese central bank, the PBOC, with the yuan's parity rate, what message was that sending?
Right, that was important. The People's Bank of China, through its CFET system, that's their platform for interbank FX trading, they set the central parity rate for the yuan at 7.1359 CNY per USD. Now, this was a slight weakening, 37 pips from the previous fix.
Okay, so weaker yuan. Why?
Well, market participants generally interpreted this weaker fix as a signal that Chinese authorities are, let's say, comfortable with a gradual depreciation of the yuan. The goal here is likely to support exports. That's a key component of their economic strategy, especially amidst ongoing global demand concerns.
So very much central banks influencing shifts with policy stances.
Yeah.
Actively managing currencies for economic goals.
Absolutely. It highlights that direct influence.
Okay, so we're seeing central banks actively managing policy. Let's shift to a sector that really felt the pinch yesterday. Commodities and crypto. Looks like both took quite a hit. What drove those declines? What does it tell us about underlying demand?
Yeah, it was definitely a broad sell-off across both commodities and crypto. For crude oil, WTI fell to $62.54 a barrel, down 1.38%. Brent dropped to $66.01, down 0.89%.
Why the drop?
Primarily pressured by speculation of rising U.S. inventories, meaning more supply, and also that continued lackluster Chinese demand, which implies weaker consumption globally. Natural gas prices, specifically Henry Hub, sank even more, down 4.48% to $2.76 per MMBtu, million British thermal units. It's a common pricing unit for natural gas. That drop was due to mild weather forecasts and ample storage, just reducing demand.
Gotcha. And the metals, did they follow the same trend of demand concerns?
Largely, yes. Metals saw declines too. Gold slipped 0.5% to $3,315.78 an ounce. Silver dropped 1.67%, and copper, which is often seen as an economic bellwether, fell 0.96%, again on slowing manufacturing demand concerns. Iron ore, however, held near flat, a bit of an outlier there.
Okay. And crypto, what happened there?
Looking at crypto, Bitcoin slid roughly 2.4% to $113,474. That extended a multi-day pullback it's been having. Ethereum actually underperformed Bitcoin, losing 3.5%. Traders were citing unwinding of leverage and some outflows from those spot-based ETFs.
The exchange-traded funds holding actual crypto.
Exactly. And this also seemed to reflect some profit-taking ahead of anticipated U.S. regulatory updates for the crypto space. Just created a cautious mood overall.
So demand concerns and regulatory anticipation weighing heavily on these markets. Seems these sectors are particularly sensitive to shifts in both economic outlook and, well, regulatory clarity.
Very much so. They react quickly to those signals.
Okay, and a quick check on real estate. What's the picture there, especially with mortgage rates still quite high?
Real estate showed an intriguing divergence yesterday. REITs, real estate investment trusts, companies owning or financing income-producing real estate, they showed a modest intraday gain. The FTSE All REITs Index gained 1.83%.
Oh, interesting. Why?
Well, this advance probably reflected easing long-term yields a bit and maybe renewed interest in property-linked sectors, perhaps anticipating future yield shifts. But, and this is crucial, you have to balance that with the broader housing finance picture. The U.S. 30-year fixed mortgage rate held stubbornly high, around 6.58% for the week ending August 14th.
Still very high.
Still very high. And that continues to keep housing affordability really tight for many people.
So institutional money might be flowing into REITs, but the average home buyer is still squeezed.
Exactly. The intriguing part is that while institutional investors might be finding value in these income-generating real estate assets, the individual home buyer remains stifled. It really highlights a kind of two-tiered real estate market. Savvy capital flows differently from Main Street affordability.
That's a great point about the two-tiered market. It seems real estate is seeing some selective interest despite those broader housing affordability challenges. So as we power through the midweek, what are the crucial events and data points investors and businesses should really be watching for in the coming days?
Right. Connecting this to the bigger picture, the immediate focus is definitely on several key data releases, and most importantly, the Federal Reserve's Jackson Hole Symposium. That begins on August 23rd. It's a gathering of central bankers, often provides significant insights into policy outlooks, can be a major volatility trigger.
Definitely one to watch. What else before that?
Before that, we have upcoming U.S. PMI Purchasing Managers Index and durable goods data. Also, the EIA Weekly Petroleum Status Report, initial jobless claims. Further out, NVIDIA's fiscal Q2 results on August 27th will be very closely watched, especially given its slide yesterday.
Okay, so the Fed's tone at Jackson Hole could really set the stage for the rest of the month, couldn't it? What's the general market outlook based on these catalysts?
It really could. A hawkish tone from Fed officials at Jackson Hole, meaning they signal commitment to higher rates that could re-steepen yields, put renewed pressure on risk assets, maybe reignite that risk-off sentiment we saw.
And the alternative?
Conversely, any dovish hints suggesting maybe a more relaxed stance on rates that might just revive the tech-led rally we saw earlier this year. Energy prices, they remain vulnerable to inventory data, especially those EIA reports, and any commentary from OPEC. And FX traders, they'll be closely watching the People's Bank of China's actions around the yuan fix, particularly after yesterday's weakening signal.
Okay. And for our listeners managing portfolios or company finances, what are the sort of operational watch items, the implications they should be considering right now, especially with these events coming up?
Yeah, good question. For CFOs and Treasury teams, that elevated movie index, the bond volatility gauge, plus upcoming Treasury auctions, it suggests potential volatility in long duration yields. So it's really crucial to monitor funding needs around those auction dates. Also, the euro's strength against the dollar and that weaker yuan fix, they highlight divergent central bank stances. So multinational firms should probably revisit their hedge ratios, manage that currency exposure.
That makes sense. What about from a risk management perspective? What should they be stress testing for?
From a risk perspective, that persistent 20s yield curve inversion,
Still inverted.
still inverted. That's when short-term Treasury yields, like the 2-year, are above longer-term ones like the 10-year. It's currently around negative 57 basis points. It continues to signal recession risk. So it's vital to maintain robust stress tests for credit portfolios, especially as credit spreads remain near their cycle tights, meaning relatively narrow.
Right, and for investors,
Yeah.
CIOs.
For chief investment officers, well, the declines in oil and natural gas on those demand concerns mean energy-heavy portfolios might face continued pressure if EIA data confirm inventory builds. And with Bitcoin's recent drop and that ongoing regulatory uncertainty, cautious position sizing in crypto is probably advisable. And keeping an eye on forthcoming SEC and ETF announcements will be key.
So Jackson Hole, definitely under the microscope. And for those of you managing portfolios or company finances, keeping an eye on these operational implications is critical for navigating, well, the weeks ahead. If you're looking for intelligence that doesn't just keep up but keeps you ahead, Nexsight delivers. They support executives, analysts, and investigators worldwide with insights that are not only reliable, but immediately actionable. That concludes the Tuesday, August 19th, 2025 Intelligence Brief, brought to you here on this Wednesday, August 20th edition of The Deep Dive. Don't forget to subscribe on YouTube and Spotify, and drop us a like, share, a comment. We'd love to hear your perspective. Here's to powering through the midweek with sharper insights. And remember, even with market ups and downs, that persistent 2s10s inversion still whispers of underlying economic shifts. What does that signal for your forward planning, and how are you positioning yourself for what might come next?